Hi, everyone. I'm Rick Bensignor, and this is my weekly In the Know Trader show. Well, if you were missing some of the volatility we saw late last year, you've certainly got plenty now to keep you busy. In early May, we saw the VIX jump from 13 to as high as 2338 in just 4 days. It's now stabilizing near its very flat 200-day moving average, just beneath 17, and hopefully things will calm down a bit. The China trade deal is certainly not kaput, but there's also no additional formal negotiation scheduled, leaving investors with no clear sense of what to expect next. And without the Fed changing its tune and potentially guiding rates lower, right now, I'm not sure we could see new all-time highs in the S&P unless trade talks resume and actually we see some progress. Starting things off here, just want to remind you how to contact me. I do receive lots of emails each week from listeners of this podcast. It's rick@inthenowtrader.com. Also, I want you to check out the website, inthenowtrader.com. Recently, I've put up a bunch of videos. There's probably close to a dozen of them that you can watch as far as reference and some good things about trading psychology. So go to the media page on inthenowtrader.com and you'll find a bunch of videos to keep an eye on. Today, I want to take a look at the Russell 2000 it's really seen the worst decline of the 4 major U.S. stock indexes since the market peaked. And we'll take a look a little bit at why and what the chart's showing. And then this week, I want to go into an area that I don't often delve into, and it's the REIT sector. But REITs, as of last Friday, were up 17.7% this year. That's beating the S&P by about 3.5% or so. And it's the third best performing sector of the year. So I wanted to spend the bulk of today's show taking a look at a bunch of S&P 500 REITs. So we're going to stay in the large cap area. And you can see here we've got a list of, 10 or 12 or whatever the number is to go through and make our way through to get a sense of how you want to be positioned in these things such that you may be able to get an edge on something that's outperforming. So let's start with charts and let's flip over here. So this is the Russell 2000. And I'm not typically a big viewer per se of the 50-day and the 200-day the way many people are. But I wanted to put them up on this chart just because even late last week, Friday's high and Thursday's high came right into where both the 50 and 200-day came together. Clearly, the 50-day is the purple line. It's closest to price action. The slower 200-day is the green line. So we kind of ran up to them and pulled back a bit. So that's the first thing. And the other indexes, none of the Dow, the S&P, or the NASDAQ are beneath both. So this definitely puts this in kind of technical structure as the weakest of the 4 major indices. I also want you to notice that in April, and here, let's see if I can take my cursor and kind of show you right in this section here, we've got 2 sequential 13 upside exhaustion signals, of which this dotted line here, that's inside this teal colored box, that's the risk level. In other words, that's the theoretical stop out for these signals saying that you've exhausted the up move. And it's that line, which comes in at 160.92, essentially is the high of the move. We got to look 161, so 20 cents above. Not only did it not close above there, but it wouldn't have, even if it had, it would not have stopped out the idea that this was exhaustion of trend from these sequential 13 signals, because it's also how you get through the level that determines if it's actually stopped or not. So The second thing here that's kind of negative is that we've got upside exhaustion signals, and that it tested its risk level and has come back down beneath where those signals came in, beneath the 50 and 200 day, at least for now. Thirdly, that's not showing up so well for the Russell is that this level here in purple, which is at 153 and small change, is called a bearish propulsion momentum level. It says this model suggests that if we get through this level properly, which we did yesterday, that there should be enough downside momentum to get down to the exhaustion level of the propulsion signal. Now that's all the way down at 145. So that's kind of three elements on this chart that would suggest that the Russell stays the weakest, at least for now. Now, I would have liked to have seen, for truly a bearish scenario, that today gapped lower after breaking down yesterday rather than gapping higher today. So that puts this a little more in question, even though the signal is, in fact, there. So there is an active bearish propulsion signal that's in place. And by the way, the propulsion model, as well as the sequential model, are both models that were designed by Tom DeMark. These are institutionally used models. And as you know from listening to any of my prior podcasts, my goal in the No Trader and doing these webcasts, essentially, or call them video podcasts or the show, whichever way you want to call it, my goal here is to expose you to institutionally used models that the public generally does not have access to show you how professionals in the industry are playing the markets and the key levels that they're playing off of in order to make their decisions. So again, the Russell's not looking really great, but I want to show you one other chart before we get to the REITs, and that's Russell versus the S&P. And what we see there is that there is an uptrend line that goes all the way back to the 2016 low. I don't know if, too much to kind of reshape and build into this. But this line goes all the way back to the 2016 February low. Notice now we have downside exhaustion. Two signals came in April. We rallied off of them. We've pulled back, and now we're on a setup 9 count. This is, in my opinion, as good a chance as you have to buy a pair trade of long Russell, short S&P as you're going to have from a risk perspective. If it's wrong and the ratio breaks under 0.5329, again, kind of properly with the rules that we have, but you're talking about perhaps a 1% downside risk relative to the fact that this is now the bottom and that this has room to go to at least test up here at 55, if not even the bigger target area up here in yellow. So even though the Russell has looked poor, and honestly, I can't quite figure out, given all the China trade talk issues and stuff like that, why the Russell, which is primarily domestic U.S. stocks, would be as affected or as negatively hit as some of the more global type of companies. Nonetheless, this is what's going on. And to me, this looks like a good setup for a pair trade to be long, let's say IWM, the Russell 2000 ETF, versus short spiders. So I in fact do favor going after the small cap names right here and right now with a 1 to 1.5% stop out on the differential of how those two trade against each other. So that's a pair trade that I like. All right. Now let's kind of take a move into the REIT space. Again, REITs have done very well this year. I don't think too many people would have expected that to start the year. As I mentioned earlier, they're the third best performing sector out of the 11 sectors that make up the S&P. And they're outperforming the S&P by 350 basis points or so as of last week. So let's go through some of the names. And there's lots of different subgroups of REITs. So this one we're going to start off with. This is SL Green Realty. The ticker is SLG. This is in the office REITs space. A clear downtrend that goes back. By the way, this is a weekly chart. So I don't know, some way, well, I can either draw it here or we can just draw it to the ultimate high. Clearly in a downtrend over time. Many of the peaks, the cloud model has kind of given you a sense of a top. And here's the one thing here that I see now. There's a 13 signal here that's just above the propulsion signal, which would be bearish, saying potential downside exhaustion. So to me, it's probably too late to be selling this. I would not want to be shorting the name here now. I've also got it just in a simple sense. If we take a look at this low going back to 2016, we had one Friday close beneath it, and we've come right back. So enough here to say potential long-term double bottom. You know, you've got a triangular bottom, a triangular pattern. We are showing potential downside exhaustion here. So no longer am I a seller of the stock. If you're aggressive, you could start nibbling on it here in the low 80s. But my view is too late to be a seller. And just to give you a sense of this model, there's an upside exhaustion signal here. There's an upside exhaustion signal here. There's a downside exhaustion signal here that was not good. There's a decent one here that was at least good for 6 months. And now we've got another downside exhaustion signal. So too late to sell. And possibly if you're interested, you start to nibble on the long side. Here is HCP. This is in the healthcare space. And you can see that this bottomed in January of, or first quarter of 18. It's moved up higher. It's now running into some signals that it's exhausting itself towards the upside, again, making this a much higher new long at these levels. So if you're going to be a buyer in this name, let me see. Yeah, this is broken out above the downtrend line. In fact, broke above, came back to it, found some cloud support at the same time as moved higher, but now suggesting some stall. And in fact, this week's a week 12, which means next week with some strength, it also is indicating potential exhaustion. So here, to me, this is a name I don't want to chase after here. If we got down to, and let's make an ellipse here, make it easier to see. If we got down to this level in purple, which is 27, I think, what do we got there? 27.49. So let's say, you know, somewhere in and around 27.5, maybe even 27.75. This is a name I could buy on a pullback. At that point, again, I should have some cloud support into it on the pullback down. It has broken above the downtrend line. So this is a name I would favor buying on a pullback. Let's go into the residential space now of the REIT sector and take a look at EQR. So let's take this line away because it's not an accurate line. It just carries, the chart carries the trend line from the following, from the previous chart I did. So now take a look at this. This also bottomed in the early part of 2018, just like HCP had. And, but here now we have a clear chance for, oops, wrong. We've got a kind of a decent uptrend line to work with off of the lowest low. So there's your trend line going forward. You're still in the midst of some near-term exhaustion. It has, notice on the cloud model, it's held this pink line. This is what's called the conversion line. It's the first support level in the cloud model. Second support level would be this orange-colored baseline, and then the cloud itself, the shaded zone, would be the third area of support. So given that we're kind of stalling against the risk level from this 13 right here, we either need to properly break above it, or more ideally, I would say if for some reason this gets a pullback down to this level here near 71, especially if it happened quickly. And I don't know if these guys have reported yet or not, but if there was some reason we got down towards 70 in the next month or so, I'd definitely be more inclined to be a buyer there than chasing after the name up here. Let's look at Avalon Bay, AVB. Same type situation in the sense that we've got a trend line off of the low, and this also bottomed in early 18. So let's redraw this. But you can also see it's a much stronger stock. Look at the kind of the angle of ascent compared to anything else we've looked at. This has really moved substantially higher, taking out the 2017 high. Again, up in here, we're getting some exhaustion signals. We haven't properly cleared either of these. Again, I want to show you here, even though we've closed above, there's a 13 in here. This is the risk level on the 13. We've gone above it, but this line is still drawing, which means it's active. We haven't properly broken above it. We got a new 13, and there's a line here. So this is extended here, and it's a shame. You know, look, we happen to be looking at REITs this week, but you can see about, I don't know, 5 weeks ago, this sold out right to the propulsion level that we were saying on the other charts we'd love the opportunity to get. In this case, Avalon Bay has already done that. It got down to just about 193 and has bounced strongly. So we know that that's a critical level going forward too. So this name is the best name we've looked at. It's just right up in here. I kind of have a hard time chasing after it. I'd wait for a little more consolidation and maybe a pullback again, even to the conversion line, which even a couple of weeks ago it bounced off of. This has done everything you would have expected it to if you were a bull. It's definitely holding support on the pullback. So this may spend some more time here before it makes its way higher. Let me just see if yeah, this is all-time highs. So this is darn close to all-time highs, and certainly in relative strength terms to any of the other names in the sector, this is the best name so far that we've looked at. Let's move on to Essex Properties, ESS. This also looks like it is on darn close to all-time highs. This has been in a much steadier uptrend. In fact, we can go back. Here's the 2016 low. And if we draw a trend line here, we've got a couple points on the trend line. The trend line then shifts angles. If we make a very aggressive trend line, we can even say that something like that is what is going on. So this is also in relative performance terms, one of the top names along with AVB, close to all-time highs. The 9 count in here, also part of the sequential model that is 9 consecutive Fridays, or it's a weekly chart, so 9 consecutive weeks, that the close on Friday was above the close from 4 Fridays prior. That often is a temporary stall point. In this case, back in 2017, it was a full half-year stall point before we made the actual low, and that low was followed a little bit later with a downside exhaustion 13 signal. We've now pulled a 9 count on the upside. We did, we at least pulled back to the propulsion level, which only had 1 close underneath. We pulled back. This is a decent name. This is actually, if we got a, let's see, Friday close, no, last Friday was up. If we can get a Friday close above 289, that comes on a week that the prior Friday was a down week, then I'd buy that for a next target for close to 307 or 306. So in general, this name I like. Let it spend a little more time, but I think it'll resolve itself to the upside. That's the residential space. Now let's move it to retail REITs, and we'll start off with the biggest of them all, Simon Property Group. So let's take a look what this chart says. Okay, so this, unlike some of the other names, when it bottomed in early 2016, it made an all-time high, and then it fell apart. But look what happened. Well, on the bottom of the move, sequential downside exhaustion signal right in here, comes back and then does a 9 down, a setup 9 down, kind of same level. And so let's just look at this in kind of big terms here, how much signal you have here that trend is likely exhausted to the downside. And now, so anywhere in here, the models we use that, again, institutions use, just pick a price, doesn't matter, 155. You could have gotten long. And now you've got signals on the upside, reverse signals saying exhaustion somewhere in the let's say 180 to 190 level in here. So these models are very good at often being able to tell you where what appears to be trends in one direction actually are no longer necessarily worth playing in that direction. And this is how we often, this is how for the last several years I've been able to outperform markets. In 2017, our official newsletter results tallied 75.1% return on invested capital. Last year we did 24.3%. And as of a week ago, we were up 15.6%, no, 15.3% this year. This is not trying to match the S&P. This is not being invested all the time. This is opportunistic trading, but the return on capital every year beats what the S&P is doing because we pick our points. We're not in the market all the time. And we're pretty good at picking turns in the market. And if you speak to most people on Wall Street who are really successful at doing this game over time, they will tell you that the best way to make money over time is to be properly positioned at the turns. And most people don't have the tools to be able to do that. And that's why I continually show you these models. And these are the same models we use in the No Traders weekly newsletter. It's so that you as individual investors have access to some of the most sophisticated models that institutions use. And I know of, I couldn't even tell you 2 other people that, in fact, as far as a retail newsletter, I can't think of anybody else who does this, let alone with the accuracy that we've done this with. So that's why we keep showing this to you. Right now, we're close to support at the bottom of the weekly cloud. Notice the weekly cloud held on that pullback from the first 13, then we get the second 13, we come to the weekly cloud. You may want to nibble in here because there's no one level, but if I kind of just draw a line across kind of where it broke out from and some of the tops in here, this is the same area. That seems to be the inflection point on this chart. You know, beneath it, you stay beneath it, you get above it, you kind of stay above it. So here's a name that I don't mind taking a little nibble on, anywhere from, let's say, current price down to, I don't know, 165 or so. Okay, next is ticker symbol, just the letter O. It is Realty Income, also one of the larger S&P 500 REITs in the retail REITs area. Let's take this away. So this bottomed in 2018 and has moved up nicely, a good solid uptrend. So let's kind of see here. That's the first line. And here's your second line. So again, 13 upside exhaustion signal on the top, 13 and 9 here closer to the bottom, not the exact, the 13 didn't have the exact bottom, the 9 was pretty darn close. We've had some upside signals before. I can't tell you why now, just because it would take up too much time, why this 13 wouldn't have mattered, nor this 13. This 9 would have, and it did have a quick move down. Again, held right at that propulsion level, right in here, that purple line, rallies, and then now is showing exhaustion again. Also look just versus prior highs, makes a minor new high, pulls back, shows exhaustion. If this breaks down beneath 67.88 on a Friday close, in fact, if it happened this week and next Monday gapped lower, this would actually kick in a new propulsion sell signal, and it would target this 61 kind of zone in here, this pink line. So this is one I don't want to buy right now. You do have a double top, and it's showing upside exhaustion. It hasn't broken down yet beneath this 68-ish level. So I'm kind of just a little bit more neutral here. But given the opportunity in the low 60s, I'd be all over this on the long side. We've got a couple minutes to go. Let's look at Kimco, KIM. And there we go. Now we have a clean chart. Downside exhaustion on the lows. We've got some upside exhaustion signals. This pulled back for several weeks. This one now is kind of stalling the market, and we are against, so it's here, let me blow this up. These kind of bluish green triangles are the upside propulsion signal. Properly getting through it said we would get to this teal colored level, which is pretty much where we've stalled against, accompanied with upside exhaustion from the sequential model. And for basically all of 2019, this is treading water in between $17 and $18. This actually could get a bullish signal if this Friday closed above 1825, next Monday gaps higher, and we trade above this week's high, then it would next target both the risk level at 1974 and the next propulsion target up at 1962. So there is a possible breakout trade here coming, all depending upon how we close this Friday. Again, this Friday would have to close above 1825, gap higher next Friday. Gap higher next Monday morning on the open, and then trade above this week's high anytime next week, would then target this move as a near-term breakout. So let's finish up here today with, let's go into the specialized REIT sector. We've got less than a minute to go or so, so let's take a look at AMT. Let me get rid of these rectangles. So this is clearly one of the stronger names, if not the strongest. Now, we are showing upside exhaustion, so I don't want to be a buyer here. However, if, let's see, up, close, down. So if we get 2 weak closes under the conversion line, then I'd play for a move down to and get long in this level right in here. If we get a pullback down towards just under 180, that's where I'd be a buyer. So that's this week's show. Again, we went into the REIT sector, something we don't often delve into, and that's going to do it for us again. Contact me at rick@inthenotrader.com, and of course, check out our website, inthenotrader.com. That's it. We'll be back next week, and have a good week.
Tom McClellan and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.